Welcome to FX Smart, your go-to place for powerful, no-nonsense trading strategies that actually work. In today's video, I'm going to share a 3-step formula that I've personally backtested thousands of times. And the results? Every single month I tested it, this method proved to be profitable in the long term. No indicators, no confusing patterns, just pure price action at its finest. By the end of this video, you'll have everything you need to apply this strategy and take high probability trades, just like this one, potentially turning small setups into serious profits. So, if you're serious about leveling up your trading game, hit that subscribe button and join the FX Smart community. Let's get into it. To get started, the first step involves understanding market structure. This is arguably one of the most important parts because if you mess this part up even slightly, it can ruin the entire strategy. One of the very first things you learn as a trader is the concept of uptrends and downtrends. It's almost like the sippy cup of trading. A chart that forms higher highs and higher lows is considered an uptrend. A chart that forms lower lows and lower highs is a downtrend. Simple enough. Everyone knows this. Now you might be thinking, why are we even going over this? I already know all of this. But what if I told you that you're probably doing this completely wrong? Let me explain. Imagine a chart that's making higher highs and higher lows. That's clearly an uptrend. But then price starts heading downward and breaks a recent low. At this point, most traders make a big mistake. Since price broke that low, they assume it's a reversal and that we're now in a downtrend. So they start looking for short trades, thinking price will continue lower. But what if I told you that the chart is still fundamentally bullish? You see, sure, price made a lower move, but that low is not a valid low, at least not yet. Why? Because price never broke the actual valid low, which is found elsewhere on the chart. The only way you can confirm a valid low is if it had previously broken a high. If price goes down and creates what looks like a low but didn't come after breaking a previous high, then it's not valid. This is really important. A low is only validated if it follows a break of the previous high. If you don't understand this part of the strategy, it simply won't work. So if price breaks the previous high, that confirms a new valid low. Now we know price is in an uptrend, and we should only look for long trades. The only time to consider short trades is if price breaks that valid low. Price can move up, down, sideways, anything, but as long as it doesn't break that valid low, we're still in an uptrend. So if price moves lower and breaks a recent low, many would say it's now a downtrend. But if that low didn't break a previous high, it's not valid and the trend is still bullish. We're still respecting the prior valid low. If instead price moves up and breaks the previous high, then the valid low gets updated. It shifts from the old one to the most recent one. I know this can be a little confusing, but just remember, a valid low is only confirmed when it follows a break of the previous high. If you can remember that one simple rule, you'll always know whether you're in a bullish or bearish trend. Now that we've identified the trend, we only trade in that direction. For example, if we're in an uptrend, we only look for long trades. Shorting in an uptrend is just silly. Now, we move on to the next step, identifying supply and demand zones. Once we confirm we're in an uptrend, we look for demand zone opportunities. Demand zones appear in uptrends, and supply zones appear in downtrends. A good rule of thumb is, buy from demand zones and sell from supply zones. Why buy from demand zones? Because those are the areas where the market previously made a strong upward move. That shows the buyers were very active in that area. So if price returns to that zone, it's likely traders will buy again. Supply zones work the opposite way. When we see a sharp drop from a specific area, it shows that sellers were in control. If price retests that area, sellers may step in again. This supply and demand concept is the core of the strategy. But we still have one more step to go. Before we move on, let's test what we've learned using a real-life chart. Looking at the chart, we see price moved up, pulled back, and then broke the previous high. That means we're making higher highs and higher lows, so we're in an uptrend. And in an uptrend, we only look for long trades. No sell positions. Shorting here would be pointless. Since the valid low broke the previous high, we confirm it's our key level. Price will only switch to a downtrend if it breaks that low. Now we look for demand zones. These can often be found in areas of consolidation or where price moved sideways before a strong move up. We spot some consolidation, then a big impulse move upward. To mark the demand zone, we take the candle right before the impulse move and draw a rectangle from its low to its high. That's our area of demand. Again, we ignore supply zones because we're only focused on buying in an uptrend. Now we wait for price to re-enter this zone. When it does, we enter the trade. We set our stop loss just below the demand zone and take profit at the recent highs. And boom, we have a clean, easy trade. That's one winning example, but I want to show you just how accurate this strategy is. Let's go over another example. Here, price is making higher highs and higher lows. The low that broke the previous high is our valid low. But this time, price breaks that valid low, so we're now in a downtrend. In a downtrend, we only look for short trades and supply zones. We find our supply zone, wait for price to come back up to it, and then enter. Stop loss goes above the zone, and take profit is set at the recent lows. Another clean trade, but we're not done. Price forms another supply zone higher up. We wait for price to return to it, enter, set stop loss above the zone, and take profit at recent lows. Another winner. And again, price forms yet another supply zone. We repeat the process. Wait, enter, set stop loss, and take profit, another win. That's the power of this strategy. First, it's extremely accurate. Second, you're always trading in the direction of the trend, which significantly increases your chances of success. Now that you understand how powerful this strategy is, let's improve it even more with one final step. The last part involves risk to reward. Sometimes even if a trade checks all the boxes, it might not offer a good risk-to-reward ratio. For example, if your stop loss is too large and your potential reward is small, the trade simply isn't worth taking. We only take trades if the risk-to-reward ratio is greater than 2.5 to 1. That means for every $100 we risk, we want at least $250 in potential profit. Even if a setup looks perfect in terms of market structure and demand, perfect in terms of market risk to reward is under 2.5, we skip it, no exception. This one simple rule alone significantly boosts the profitability of the entire strategy. For example, let's say price is making higher highs and higher lows. That tells us we're in an uptrend. We identify a demand zone where price consolidated before a strong move upward. We wait for price to return to that area, enter the trade, set our stop loss just below the zone, and place our take profit at the recent high. We check the risk-to-reward ratio, and if it's 3 to 1, we're good to go. Now let's take a look at this example. First, we need to analyze the trend. As price forms lower highs and lower lows, this clearly indicates a downtrend. In a downtrend, we should be looking for supply zones to enter short trades. So we identify the first supply zone and wait for price to return to that area. Once price reaches the supply zone, we don't rush in, we first check the risk-to-reward ratio for the setup. In this case, the trade offers a solid risk-to-reward ratio of 1 to 2.5, which means it meets all 3 steps of the strategy. 1. Identifying the trend, we're in a downtrend. 2. Locating the right zone, supply zone. 3. Confirming a good risk-to-reward, above 2.5. Everything lines up, so let's see how this trade plays. Let's walk through one final example together. As you can see, the market is currently in an uptrend. That means we should only be looking for buy positions. We begin by identifying a demand zone and wait for price to return to that area. Once price reaches the zone, we check whether the risk-to-reward ratio aligns with our strategy. If it does, we enter the trade. However, notice what happens next. Price breaks below the last valid low, which was the key level that led to the formation of a new high. As I mentioned earlier, when this valid low is broken, there's a strong chance the trend is reversing. So now, instead of looking for buy setups, we shift our focus to sell positions. That means it's time to stop marking demand zones and start identifying supply zones. I go ahead and mark a clear supply zone and wait for price to react to it. As price enters this zone, we start to see the formation of bearish pin bar candles with long upper wicks, indicating strong selling pressure from that area. Based on this setup, we now have an opportunity to enter a trade with a risk-to-reward ratio of 1 to 3, which fits perfectly with our strategy. All conditions are met, and once a clear bearish candle forms, I confidently enter a short position. Thank you so much for watching. If you found value in this video, don't forget to like it, subscribe to the channel, and let us know in the comments what kind of videos you'd love to see next. And if you want to get better at identifying supply and demand zones, make sure to check out our previous videos in the Smart Money playlist, where we cover exactly how to draw and recognize these zones in detail. See you in the next one.